What the data is telling us looking beyond the headlines, I think there's a lot of interesting things going on. Nothing major, but a couple small tweaks. Certainly the SpaceX IPO is a big deal this week. Something we're definitely thinking about, but not necessarily as positive on it as some people are. It's fascinating. We've had only a handful of requests or talks about it, but we've had people who are super excited about it and some who want nothing to do with it. So it's fascinating. It's all over the board. But we're talking about, IPOs are really not all that they're cracked up to be. We're going to look at June seasonality, just the same seasonality. I think we're in the Trump years style. It seems to be following the most closely. So we're going to think about that. We're going to look at all the money flow stats that I love to show you. And then I'm going to continue the UPI, the Ulcer Performance Index discussion, and show us how we use it to score our models, score how we're doing. And it helps us know if our risk-adjusted returns are hitting where they need to be. So we're going to talk about those things. Let's start with IPOs. So 30 major IPOs in their first year track records. Now, this is fascinating because this is like Facebook, Twitter, Alibaba, all these huge names that ultimately did pretty well as stocks. But in the first year, the average and the median drawdown was about 55%, 54 to 55%. So think of if you buy into the SpaceX IPO, you might lose half in the first year and before it starts going up again. So I wouldn't jump into this. I wouldn't be too eager to jump on IPOs. IPOs don't usually come out for the good of the public. It's for the insiders who bought months, if years ago, to get out of their shares. They've made the money. This is just dumping it on the public. So I'm not a big fan of jumping in on IPOs. I think it could be a good stock. SpaceX specifically could be good in the future. I would not touch it. And if it goes down 50%, that might be a place to be looking at. But it's really too early to tell, too hard to say. The valuations don't make sense at where they priced it. So I think it has a very good likelihood of playing out this way. So I'm keeping that in mind. Never a big fan of IPOs, but a lot of people are asking about it now, which is interesting. The Trump year specifically, it seems like the market is following this the most closely. We are getting a little bit of a pullback in June. It's a few percent, nothing huge. Looks like we're bouncing back up today. So we're actually following the almanac this last couple of weeks pretty closely, where Monday was positive, Tuesday, Wednesday were bears, and then today and tomorrow, meaning Thursday, Friday, and actually I think Monday, are all bull days. So they should be positive. Historically, it doesn't mean it has to happen again, but we're kind of in this really interesting, just choppy season. And we're in the sell in May and go away period, right? From May to October, the market usually does not go up that much. We may have already seen our good gains in April and May, really, and that might be all we see for a while. Maybe we just grind sideways. It's very possible, and it's actually probable as well. So we'll see, but typically, in these years, we get these grinds sideways or slightly sideways to up, and that's usually pretty positive. So we will see how that plays out. Of course, our money flow, it's really just sideways. We're not seeing panic. We're not seeing money flooding out of the market. That's something that I really want to pay attention to. We're above this purple line, which is the 55-day exponential moving average of the advanced declines. So when this starts falling, money's coming out of the market pretty aggressively, but we're just not seeing that. We're not seeing much reason to be concerned. Short term, sure, we had a little blip, back here about a week ago. The market sold off a little bit. Nothing to be concerned about. Today is up. I'm not really sure where this might actually be turning up today. So nothing too concerned there. We're certainly above this red line, which is where you're like, okay, something's up. We're just kind of this natural ebb and flow movement of the market. Nothing really exciting or to be too concerned about, at least not yet. The VIX is a little high. I don't have a chart for that, but it's not that high. I'm not that concerned about it. Market indexes are 100% on the right side of a negative. Now, this is short term, and most of the internationals are trending down, right? EEM is emerging markets. EFA is developed, Japan, Latin America, and China. That's the ones that are trending down. And, as we tend to lean domestic, certainly lately, all those are doing much better than those. So day follows night. These will eventually move to this side and there will be another run. I don't know when that will be. Maybe it's starting today. It could be. Maybe it's not. We could also be seeing a long-term top here. There's other reasons we could look at that as well. I know our guy, Chad Carnes, I'm going to give him props, and maybe he called the top last week, but we'll have to see, because typically when major IPOs happen like this, there's some fun coincidences to check out. So take that, Chad. All right. All right. Sector ETFs. It's interesting. Last month, it was almost opposite, right? All the growth names were over here. All the value names were over here. We've kind of switched a bit. We've got, XLP is defensive. XLV is defensive. XLF is good. That's financials. They're doing all right. But we've got tech, here, utilities, XOY is consumer discretionary, and C is communications, trending down. Interesting. It's not super, it's just mixed. It's really just messy. When these all agree on one side, when the sectors agree, that means the S&P has a trend in one direction or the other. Right now, it really doesn't. It's just a choppy mess. And that goes into the RRG charts, gives this another great way to look at it. At the end of March, before the market really took off, these all grouped down in here, and that's fantastic. Right now, we're grouping around the zero line, which is like there's no momentum, there's no strength. It's just they're just kind of pouncing around. There's really nothing exciting. XLK, which is technology, has really fallen out of its lead. That was really what led the market higher, and it usually does. But at this point, it's just kind of pulling back. This could certainly turn up from here. It's not unheard of. But I want to see more of these agree, and there's no agreement in these sectors. There's no real strength. There's no real weakness. It's just messy. So that's really nothing to be excited about. Again, I love to see groupings down here because that means we push up, and that's exactly how April, May played out. And that gave us the fantastic setup for it. Beyond that, new lows, there's really not a whole lot to be concerned about. We're still sub 100 and have been. It's just nothing to be concerned about, right? When, again, I always mentioned the taper tantrum or tariff tantrum back a year or so ago. We were negative 1,000. 1,000 stocks were going down. Right? This is just such a small number of hitting new lows that, again, if this pushes down below here, then you're like, okay, there's something to be concerned about. And just like we had in March, right? This was March, and that it was like, okay, the market is actually selling off, even though 200 is not much. You can see that it wasn't bad, but we're just not at this point. Even though with this little market pullback, there's just nothing to be concerned about. And then finally, to kind of wrap it up, the UPI. This is the same slide I showed last time, but UPI is something we're really leaning into, both on the security selection and how we track our models and how to make sure they're acting as they need to. So really, what I wanted to focus on here: the higher UPI, the better, right? The more return for the unit of drawdown. So this thinks about how much risk are we taking to get our return, or risk-adjusted returns is what we're thinking about a lot. So the higher number is the best risk-adjusted. Doesn't mean the most performance. It doesn't always mean that, but it means risk. So the drawdown is what's going to be a big factor. So for example, market neutral is the best score for us versus the AOR. AOR benchmark is basically a 60-40 balanced, pretty standard balanced model. So I want my balanced models to score better than that. We've got one that's scoring a little bit low, and that's actually because its volatility is a little bit higher, because return is actually comparable, but the return volatility is higher, and that's giving it a lower score. Where market neutral, the return is actually very similar to what we have in this market, but the drawdowns are very, very low. So that's what gives us a great score. So it's not really about an outperformance. And interesting that you take the 403B accounts that we do at Fidelity. Right, the aggressive has the lower scores than the moderate, because aggressive is going to have a little bit bigger drawdown. Now, performance-wise, this is actually better than this, as it should be. Aggressive should return more than moderate, but when we factor in drawdowns, that's where the moderate gets a better score. So it's a neat way to see three really similar portfolios and how they are risk-adjusted returns and how that works out. So that's just how we look at scoring. We look at scoring our stuff every single day, and then this gives us a heads up. And if we need to work on something, we need to be more defensive, or the market's going up, we need to be more aggressive. It's really helped us lean into where we need to be. So I will leave you with that.